If you're thinking of buying a home soon and you want to save thousands of dollars a year on your mortgage without anything out of your pocket, well then today's episode's going to be for you. So in today's episode, I'm interviewing Mina from Guarantee Rate Affinity, and we're going to be going over everything that you need to know about 2-1 buy down programs. Now, if you're in the process of getting that pre-approval to go buy a home, you've probably heard of this before because it's one of the most, if not the most popular loan option that lenders are using right now to help reduce monthly mortgage payments when we're in this high interest rate environment. So we're going to be going over what 2-1 buy down programs are, how the numbers work, when they might be right for you, and more importantly, when it might not be right for you to do this. And that way you can make a decision when you go to purchase your new home if these 2-1 buy down programs are something that you want to pursue. And as a bonus, at the end of this episode, we're also going to be discussing the new loan limits going into 2023 and how this is going to help buyers get into more expensive homes at a lower interest rate. So let's go ahead and get into it. Okay, everybody, go ahead and welcome Mina back to the show today. She's been on, it's been a little while. So she's from Guaranteed Rate Affinity. So we're going to talk about how to save buyers money, and probably the most popular way to do that in today's extremely high interest rate environment, especially compared to the beginning of this year, is going to be these programs that are called 2-1 buy downs. So we're going to be going over them in detail today and kind of giving you a description of when to use them, when not to use them, and how these things are actually used during a transaction, so you can understand the process before you go through and start to try to purchase your next home. So Mina, welcome to the show.
Yeah, no, thank you so much, Josh, for having me in general. But yeah, I mean, it's
Absolutely.
no question that, yeah, the rates have gone up quite rapidly this year. And so this option really came about and it's making a comeback. It used to be more popularized back when the rates were a little bit higher. But essentially, the main purpose of it is to help offset the payment impact that higher interest rates have. And so to better explain, I'm going to go ahead and share a screen right at this time to kind of go through an example with everybody. So first thing I'll note, well, you do have to have this negotiated from the sellers. And the good news with the current kind of climate we're in for the housing market is, if any of you have been reading the news, you know that, yeah, it was extremely competitive the past couple of years. And still, there are some homes that, of course, are a little more competitive than others. But this is for the first time in years. I'm sure Josh would agree that buyers actually have some room for negotiation.
Yeah, it's
And
definitely not
so,
completely commonplace yet, but it's becoming very clear where you're seeing either they're with these buy downs or any type of buy downs or any kind of negotiations, buyers are having a lot more power right now. So this is something that you might not think that buyers, especially if you were looking at the beginning of the year, that sellers would be willing to put these type of things into the contract. But this is something that some sellers are having to do, especially those ones that don't have those HD TV ready homes that are going to still fly off the shelves in today's market. Those sellers that are really kind of struggling to sell their homes are a lot more open to these type of products. So yeah, go
for
ahead
sure.
and kind of walk us through it.
Yeah, no, I mean, honestly, at one point, I feel like you had to offer like an arm and a leg along with the actual price, right?
Yeah,
But
and
no,
your firstborn son. Yeah, exactly.
in any case, so here's a quick example of, actually, this is an example of a client who did utilize this program. We were able to get this negotiated into the contract. But essentially, the loan amount amounted to around $780,000. And overall, the temporary buy down, the benefit is the first year, that first number you see in the name temporary buy down, your rate's going to be 2% lower, or the payments are going to be based on a rate 2% lower than the actual rate you're in. So first off, it is still a conventional 30-year fixed loan. It's not any weird loan program. It's still backed by Fannie and Freddie. But the
Yep.
first year, your payments are going to be lower by 2% lower interest rate. And the second year is that second number there. Your rate's going to be 1% lower, or at least the payments based off of it.
Okay, and I
So,
don't want to interrupt you real quick, but I want to bring
yeah.
this to a point because it is something that I hear often with buyers right now. Is they're saying, "Oh, great, this is 2008 all over again. We're doing these ARM products where these rates are variable, and we're going to get a lot of buyers into trouble." But I want to emphasize that this is a temporary buy down. This is something that is not variable. When you get into this program, you know exactly what your payments are going to be every single year. It's not that you're hoping and praying that interest rates are going to do something in the future. You're getting approved based on the higher interest rate, correct, Mina? And
Exactly. And
making,
actually,
yeah,
Josh, like on that too, like that's a
yep,
really, really important point that you brought up. Yeah, this program is still a 30-year fixed loan, and you
Hmm.
can't qualify with a rate that's 2% lower. Your income,
Yep.
the documents you're providing to verify the fact that you can pay back this loan is still based on your actual rate that you're locked into for the 30-year term.
Okay, perfect. Okay, yeah, you can continue. I just wanted to make sure that was clear because a lot of buyers are worried that these are type of products that's going to get to the issue of all of a sudden their payments are going to skyrocket to something they didn't expect, and then now they won't be able to afford their house anymore. So this
For
is
sure,
based off
and
of what you can actually
understandably
afford.
so. Yeah, because I mean, in the past, another reminder to everybody that back then there was really no regulation in the mortgage industry. So you could literally come up to me and you could have just graduated high school and told me, I make $1 million a year.
Yep.
No verification documentation needed to be provided. So it was the wild, wild west. And in my defense, I didn't enter the industry until 2013. And so that wasn't me, but crazy thinking back to those times. So when it comes to this example, again, it's a 30-year fixed loan and the rates locked in at the current market rates. And in this case, they were locked in at 6.5. Now, what the temporary buy down allowed them to do, this is only the principal and interest payment, by the way, but 780,000 loan amount at 6.5, that's the payment that it would amount to. But the first 12 months of your loan, because you're only having to make payments off of a rate 2% lower, your payment is much lower by basically about $1,000 or $977 a month lower in payment for the first 12 months. And the second year, it's going to go to a 5.5. And so 1% lower, and that's going to save you about $501 a month for that next 12 months. And then the rest of your loan term is your fixed rate loan that you are approved for and also locked into. And that's what the payments would be. But I do want to emphasize that the reason why this program is making such a big comeback at the moment is because overall, many economists and even Fannie and Freddie agree and are preparing for the rates dropping sometime in the near term. So in the next couple of years, if the rates do drop to, let's say, a 5% interest rate, there are no prepayment penalties involved with refinancing to pay off this loan in place of the new one when the rates drop. And so this is simply for the purpose of offsetting that payment increase due to the rates. But during that time frame, our game plan is to keep an eye on the market and refinance you into that lower rate once we see the opportunity present itself. So it's a really, really great option to save on the money, at least in the short term, especially when there's enough data to back the fact that the rates may drop in the short term in the next 2 years.
Gotcha. Yeah. And that's something that we've talked about on this channel often is that, yes, the rates are looking like during pretty much every recession we've had since 1980, at the end of the recession, rates have dropped. We've talked about this before, on average, right about 1.8%. So you can kind of see that if we're hovering around the 7% range right now, that's going to bring us back down into the low fives when the recession ends. Again, history doesn't always repeat itself, but when it's 100% of the time, every single recession we've had, rates have gone down. It's pretty good indicator that we're most likely going to have rates go down in the near future. Now, again, this is not a guarantee. You can't rely on this information because you don't want to get into a product that you can't afford and that you need to be able to afford, let's say in this specific case, that 6.5% interest rate over the long term. If you can do that, these type of programs are really just for your benefit, and they're kind of like icing on the cake. So you get to purchase a home, you get a lower rate, and there's a good chance over the next 2 years at some point rates are going to drop back down. You can refinance and then keep that rate permanently lower. But again, I always want to stress on this channel that you want to make sure that you can afford the higher rate. It's not going to be any kind of financial issue for you and your family to afford that 6.5% interest rate.
Yeah, and that's something I always bring up to clients too when presenting this option. And again, it has to be negotiated, so it may not work for every single offer situation. Yep. But the main thing too, I think overall, many people are worried about, or I guess in general, the quote I heard recently is wealthy individuals, they just make decisions off of what's the most likely outcome to happen based on facts and data, right? But they're always taking some sort of action. So overall, what I recommend doing is let's focus on, ignore the buzzwords that the media throws out, because a lot of the media headlines, which I can kind of go into in a little bit too, are just, it's so off. It's very interesting that these people keep getting invited back to speak on national television. But overall, if it's very likely that the rates are going to drop because of the reasons Josh mentioned and more reasons on top, then we can try to, at the very least, make a decision on whether or not it makes sense to buy now based on that being a factor, along with making sure you're hedging and protecting yourself and you're comfortable with the payments too. But
Okay.
overall, right now, because a lot of people have been scared off by the higher interest rates, but we have to remember that, currently the generation entering the housing market are the millennial generation.
Yeah.
And back about 30 years ago, if you look at the birth rate statistics, birth rates were skyrocketing during the time that the current millennials are entering the market. And so 30 years ago, average age of first time buyers. But because right now, despite the fact that the rates went from 3.3 to a 7, and they're still appreciating the properties in some areas, Orange County, LA County are holding steady, which I'm sure many people would never have imagined that much of an increase to have such little impact. But the reason is because the demand still heavily outweighs supply.
Yeah.
And so
and that's
I think that's
something
very promising overall.
Yep. And that's something we've talked about again on this channel too. I think one of the last episodes was that millennials are going to be driving the housing market for the next couple of years, specifically at least through 2024. And then most likely slowly going down past that. But for the foreseeable future, the largest patch of millennials are entering those peak home buying years right now, getting married, starting to have kids, looking for places of their own. So that underlying demand is there. And there's always going to be people that are looking to purchase homes. So these products are helping get people into homes. Now, before we move on to anything else, the other thing I did want to kind of bring up and clarify with this, because you did mention it, is that these programs cannot be paid for by the buyer. They have to be negotiated, and the seller needs to pay for this. So would you be able to bring up that example in terms of like how much you would have to actually negotiate with the seller to be able to make this type of a program work for you?
Yeah, definitely. And so like the numbers we were running with this particular client too, the home was on the market for quite some time, and they were debating between offering at a certain price point lower than the list price, or maybe offering slightly higher, closer to the list price, but requesting a credit so we could find a kind of a win-win situation balance for both parties. But with that said, the way it's calculated with how much of a credit you need from the sellers, the main thing is the payment difference, the payment savings the buyer is benefiting from. Whatever that amounts to for the 2-year period is what the credit we need to negotiate would be. So if we go into this chart again, for the first 12 months, if you're saving $977 in comparison to your actual mortgage payment with the 6.5, then for 12 months, that would amount to this number, $11,735. Now, for the second year, again, you're saving $501 a month. And so for those 12 months, that would amount to $6,016. And that is the total number that you would have to negotiate into the contract in order for this to actually work. And so how the temporary buy down works with the subsidy, this money is going to be managed by the mortgage company. So essentially, all you have to worry about as a buyer is making these lower payments. But the question I oftentimes get is, well, Mina, let's say after 12 months, so this is used up for those 12 months, right? But what if after 12 months, I end up refinancing? Then there's still this amount sitting in this impound account that the mortgage company is managing for you. What happens to that money? And the cool thing is you don't lose that money either. So if you refinance after 12 months, hypothetically speaking, then that amount left as the subsidy for the temporary buy down will be used to reduce your principal balance. So it's a principal reduction towards your loan. So you're keeping that money in your pocket.
Okay, perfect. Yeah. And a lot of buyers are kind of asking, okay, well, why can't I pay for this? Well, it really doesn't make sense for them to pay for. I mean, it's a dollar for dollar reduction. So if they have the down payment already, and if they really wanted to do this, they can put the money in the bank and then just pay a little bit extra, $977 a month extra to have that same exact rate. So there's no reason for buyers to do this program and pay for themselves. This is really meant as a negotiating tool for you, just to, like I said, have that icing on the cake, get a lower interest rate in hopes that rates go back down. Because if you have the money, you have the money to be able to do this, stick it in a bank account. And that way, if you need it for something else, you can still have access to it, use it if you absolutely need to. But that way, you're just basically taking it out of that account, paying it, and making your mortgage essentially that same type of 2-1 buy down, but you're doing it yourself. So that's, I mean, I don't think there's any other reason I can think of why buyers would want to pay for it themselves, because there's just really no reason to.
Yeah, no, you hit the nail on the head there. Like, that's exactly the reason why. And overall, I mean, when it comes to I guess, the buyers' kind of concerns right now. And this program, it's not really well known yet to many buyers out there, right? And so
Yep.
for many people who may be holding off on buying while rents are continuously going up, to basically wait till the rates drop, many people are thinking in
Yep.
that way. They're waiting for the rates to drop. And so everyone's going to flood the market at that time the rates drop and basically put upward pressure on prices. So if that
Yep.
is likely to happen, then this program just helps to get in with a lower rate essentially for those first 12 months and the next second year, the 12th or 13th through 24th month, while you wait for the refinance opportunity. But you would have already secured the purchase price of the property and locked that in, and you may have,
Okay.
again, a little bit more negotiating power at this time rather than when rates drop.
Okay. And can you think of any reason why buyers wouldn't want to negotiate this into a contract?
I would say it depends on every family, but the main question I ask first is, what's your payment comfort level? Because overall, kind of like what you mentioned, Josh, I mean, you made a really good point of the fact that ultimately it's just money sitting there and you're kind of paying it back in a
Yep.
sense, but the sellers are paying for it in this instance. Technically speaking, if you're comfortable with the higher payment at your actual 30-year fixed locked in note rate, then it may make more sense if you can still get a pretty significant credit to
Hmm.
just use that to pay your closing costs. So you don't
Okay.
have to come in with that out of pocket.
Yeah.
And so this is helpful to offset the payment difference if payment's the primary concern for you. But
Gotcha.
if the payment at the note rate is still comfortable for you and you'd rather preserve more liquidity, then I think it would make more sense to apply the credits towards just the closing costs. So it depends on everyone's
Yep.
priorities.
Okay. Yeah. And exactly. And that's as if you think of it as an investor as well, if you have that money set aside and you can keep it, use it for the mortgage if you want to, but you can also deploy it in other investments to be able to make some return on it, then it might make more sense to go that route. Like you said, Mina, if you can afford the monthly payments, it's not a big deal for you, then this might not be the product for you. You might instead, even if you go put it in I bonds right now, those are returning, it was 9%, now it's 6%, but that's still a decent return on your money over just a year's period. So, I mean, that's something that you could be doing and actually making some money on that money that's sitting in your bank account instead of just having it sit there applying to the mortgage if you can afford it. So, okay, I think that makes perfect sense. So, anything else you wanted to talk about with those 2-1 buy downs before we move on to the next option?
Yeah, the last thing I'll mention is that there are different variations of this program. For
Okay.
example, there's a 1-0 buy down, which again, same concept. First year, 1% lower. The first
Okay.
number, second year, just goes back to the normal. And so that will require much less seller credit, right? And
Gotcha.
easier to
Yep.
negotiate in. And so I would just say, if you have any questions or you want to go over a specific scenario for yourself, then just reach out to me or anybody else that's actually
Okay.
offering this type of option and understands it clearly. Because I think
Okay.
it depends on the property too, whether or not this program makes sense and which
Yep.
structure would make the most sense for it.
Okay, perfect. Well, thanks for all the information on that. So the second thing that I wanted to talk about today, which is going to become more and more prevalent very soon, is going to be the new conforming loan limit. So first off, can you explain to people that aren't familiar with these terms what a conforming loan limit is and why it's important if these nearly conforming loan limits keep increasing in terms of how it helps buyers out?
Yeah, so it was recently announced it's going to be going up again, but basically conventional loans have a limitation on how much they're willing to lend out. So Fannie Mae and Freddie Mac are the government agencies who regulate and set the guidelines for conventional loans, but every single year they set the limit per county. And so it's different every single county, but for lower cost areas, just as an example, for San Bernardino County, Riverside County, that's considered low cost. But the loan limits this year in 2022 were at 647,200. So that means that you can only get up to that loan amount and still be in a conventional loan. And the reason why the conventional category of loan is very significant is because conventional loans are a lot more lenient in qualifying standards comparative to a loan amount higher than the conventional limit, which is a
Yep.
jumbo. Because
Gotcha.
jumbos will require a higher down payment, and they technically have a 10% down option too, but the rate difference is quite significant between a 20% and 10% jumbo. Whereas for a
Okay.
conventional 20, 15, 10, 5, they're all pretty flat across the board in terms of rates and in terms of the loan you can get.
Okay. And then the conventional limit is not the actual limit on the cost of the property. It's the limit on the actual loan amount. So you can still purchase a property over that amount, get a conventional loan, but you have to make sure you're covering the difference. from whatever the actual conventional loan limit is to what you're actually paying for the property.
Exactly. And so that's why, for anybody who's strapped with cash, if they wanted to buy a home that's around, let's say 740,000 with a 3% down payment, that would not have been possible if the loan limits were still at 647,000. Because 3% down of 740,000, that loan amount's higher than the actual amount that Fannie and Freddie are willing to lend up to. So this year, or I'm sorry, for the following year, 2023, the low cost areas are going to be upping the loan limits 715,000.
Okay.
And in high cost areas, LA County, Orange County, they're going up from 970,800 this year to 1,073,000, which is,
so
to me, I mean, saying it out loud
jump,
is kind of wild.
Yeah.
Yeah, I mean, a few years ago, I still remember when the loan limits for high cost areas was 636,000.
Yep.
And so now you can technically buy over a $1.1 million property with a 5% down conventional loan.
Okay.
And so it just helps to increase kind of more of the flexibility and wiggle room with the cash to close needed to purchase the home, if that was the main concern, of course, for your family. Okay.
Yeah. So if you can afford the monthly mortgage payment, you make a lot of money, but you're having a hard time saving up money. So for instance, maybe you live in Orange County where rent is $3,000, $4,000 a month at minimum for all these places. It's hard to save a significant down payment, even if you're making a lot of money. So these type of products, once they start rolling out, are going to help you get into higher cost properties without having to bring as much down. Is that basically the kind of the wrap of it?
Exactly. And to put kind of simply, I mean, for the low cost areas, let's say you were looking to put a minimum 3% down payment, the max purchase price you could have bought this year would have been 667,000. Okay. If you wanted to put the minimum 3%, that'll allow you to remain at the conventional loan limit this year. But next year, because the loan limits are going up to 715,000, you can now buy a property that's 737,000. So that's about, right? That's quite a significant amount.
Yep. Yeah. And especially in that price range, that could definitely make a difference in terms of the type and quality of property you can buy in these areas too. So
exactly. And for the lower cost areas for the conforming limits, they are already in effect for majority of companies out there.
Okay.
The high cost limits, they're going to be going up. If you're closing on January 1st, so in 2023, you can start going off of the higher loan limits. But if not, currently it's still the 970,800 if you're closing within December.
Okay, so if you're trying to get into escrow right now, unless you have an extended escrow period of, I mean, now we're November, we're getting closer, but basically you'd have to have an escrow period or some type of closing 60 days out or so to be comfortable to be able to use these type of higher balanced loan products.
Exactly. So Orange County, LA County, we can't go off of the higher cost yet, but at the very least, conforming 715K, we can go off of now.
Okay, perfect. Well, I think that's kind of all the basic information I need on that. Is there anything else you wanted to mention with those conforming loan limits or anything like that? Or is that, I mean, it sounds pretty straightforward.
Yeah, no, I would say it's definitely pretty straightforward. The main thing I like how you clarified that it's not the purchase price, it's the loan amount, right?
Yeah.
Because I know a lot of people get that confused, but I know for many people, it's like when you're buying an investment property or if you're buying something in the desert, if you're looking at an $800,000 property, you can't do a 5% down. And so it's just helpful to have a little bit more purchasing power. But I think that's mainly everything I wanted to at least comment on that topic.
Okay, perfect. Well, I think we covered everything pretty well in terms of the 2-1 buy downs as well as these conforming loan limits. So hopefully that gave everybody some good understanding of some ways to save yourself some money if you're trying to purchase a home right now, some exciting things coming in the next couple months in terms of how do you purchase homes, especially if you want to be putting less money down. So there's a lot of good stuff going on in the loan industry, in the mortgage industry right now to help out with these purchases and help out with these higher costs and higher interest rates. So Mina, thank you so much for coming on today. I really appreciate all the clarification and everything. I'm sure we'll have you on again at some point soon. If anybody wants to get a hold of you, what's the best way for them to do that?
Yeah, if you actually, I post a lot of educational content on Instagram, and so you can feel free to connect with me there at Mina Mortgage. And then other than that, I'll just include, in my actual profile, you can see my contact info and ways to get a hold of me and schedule a call with me. But the last thing I will mention, I think currently in this environment, it's ultra crucial to just work with a realtor and a lender who understand and knows more options than just inputting numbers like taking an order per se.
Yeah.
Or for example, but Yeah, I think that's the main thing I would emphasize to anyone who's concerned about entering the market at the moment, because there may be more options than you're aware of. And it's just a matter of making sure you're running the numbers, asking the questions, and gaining full clarity on what options you have, and then deciding whether or not it makes sense to move forward or not.
Yeah, if you're talking to a lender that's trying to fit you into a box saying this is the only product I offer, it's either you qualify or don't, probably the wrong lender to be talking to in this type of market, because there is a lot of different options out there. Like Mina was saying, not only the 2-1 buy down, the 1-0 buy down, there's 3-2-1 buy downs. There's a bunch of other things you can look at.
Yeah.
And there's going to have to be, it's going to all depend on your specific situation. So definitely when you are interviewing lenders, make sure you're asking about the different type of options so you can work together to figure out the best plan financially for you. And then same thing as an agent. Obviously, you want to make sure you have an agent that's familiar with these programs. Maybe they don't know every single detail about them, but they need to know they exist. They need to know good recommendations for lenders to talk to so you can get more clarification on this. So something you should be looking for if you are thinking of buying a house is make sure you have a good lender, have a good realtor, so you're going to get the best deal on the property, and make sure that you're fitting into the right program that's going to save you as much money as possible. So thank you again, Mina, for coming on today. I will put all of your contact information either in the show notes or the comment section below. That way anybody that wants to get a hold of you can. And until next time, stay healthy, stay happy, and I'll see everybody on the next show. Bye.
All right. Thank you, Josh.